In this video, I'm going to talk a little bit about financial institutions. Financial institutions serve as intermediaries, and intermediaries facilitate the transfer of capital between savers and those who need capital. So, for instance, if you have money deposited in a checking account and the bank takes that money and lends it out to somebody to buy a home, the bank is a financial institution that is serving as an intermediary between you, the person with some money, and the person who needs the capital, the person who wants to take out the mortgage. So some different types of intermediaries: commercial banks, um, investment banks. There are some various sort of shadow banking entities that are sort of, they're kind of banking-like, and serve or provide some bank-like kind of functionality. Basically, with banks, they typically take money from depositors of some sort, or perhaps investors, and then they loan it out and they make money off of the loans, basically. Then we have mutual funds, pension funds, insurance companies. So if you think of a typical mutual fund, the basic idea behind a mutual fund is if I invest in a mutual fund, let's say I have $1,000 and I put $1,000 into the mutual fund, and that mutual fund then takes $1,000 from a whole bunch of other investors, so they have, maybe a few $1 billion. And then they're going to take that money and then invest it perhaps in hundreds or even thousands of stocks. And so they are serving as intermediaries between me, the investor, and all these companies that are being invested in, but making it possible for me as an individual investor to invest in hundreds or maybe even thousands of companies through one investment choice. Whereas if I just had $1,000 to invest, I'm not going to be able to invest in that many different companies, just because of how expensive the different shares are and so forth. And if I had transaction costs, the transaction costs would add up very, very badly for me. So it serves as a facilitator to transfer that capital between me, the savior, with the savior with the $1,000, and the entities that I'm trying to invest in through that. And pension funds and insurance companies do some similar things where they're investing in pools of companies, but taking money from other entities in some respects and basically investing it. So they're kind of serving to facilitate that transfer of capital. Savings and loan institutions and credit unions basically work very similarly. It's just they are in many, for credit unions, they're limited typically to members of perhaps a specific profession or something of that nature. Where in savings and loans are regulated slightly differently, but ultimately they're taking the same kind of approach as like a bank, for instance, where they get money from depositors typically, and then they lend it out to people who want to borrow money. So that's the basic idea behind financial institutions. They're facilitating that transfer of capital between savers and those who need the capital. Thank you so much for watching, and have a great day.